Look, I've got to level with you right now. The past several weeks, precious metals have dominated every conversation in the financial world. We've all been glued to watching silver inventories evaporate, production facilities shuttering operations, and prices shooting through every resistance level imaginable. That attention was absolutely justified because what's happening in the silver market represents one of the most compelling stories in modern finance. But here's what nobody's talking about while we were all fixated on shiny metal bars. Something catastrophic just detonated in the bond markets. I'm talking about something so fundamentally destabilizing, so structurally dangerous, that it makes even the wildest silver squeeze scenario look like pocket change. If you want an analogy, think of silver as your early warning system, your canary alerting you to danger deep in the mine. Well, the Japanese government bond market isn't another canary. It's a thermonuclear device that's been sitting at the bottom of that same mine, and someone just activated the countdown sequence. The clock hit zero, and the explosion has already begun. The market signals we're tracking right now point towards something unprecedented, a structural transformation that's already in motion. Japanese government bonds, the JGBs that have anchored global finance for decades, are experiencing yield surges we haven't witnessed since the early years of globalization. The 10-year instrument is registering 2.34%. 20-year bonds have climbed to 3.47%. 30-year maturities are sitting at 3.90%. And the 40-year bond, the longest duration debt instrument they issue, has breached the psychologically critical 4% threshold, landing at 4.23%. Now, I can already hear some of you, especially those living in Western economies where rates have been climbing for a while, thinking this doesn't sound particularly dramatic. After all, yields in the United States and elsewhere have been considerably higher, but that reaction misses the entire context. And context is absolutely everything when it comes to understanding why this matters so profoundly to your personal financial situation. For 3 full decades, an entire generation of economic activity, Japan has operated as the world's zero interest rate laboratory. For 30 years, the Bank of Japan deliberately suppressed these rates, keeping them pinned near zero or even pushing them into negative territory, all in an attempt to keep their heavily indebted, demographically challenged economy from imploding. In the Japanese context, seeing a 10-year yield at 2.34% isn't just notable, it represents a complete cardiac arrest of their economic model. The immediate mathematical consequence is straightforward but devastating. The cost of servicing Japan's absolutely massive national debt load has just tripled, possibly quadrupled, essentially overnight. This isn't some gradual adjustment. This is a sudden shock to a system that was never designed to handle it. So why should this matter to you personally? Why should someone living in Texas or a family in London or a pensioner in Sydney care about what interest rates are doing on Japanese government debt? The answer comes down to one fundamental reality. Japan has functioned as the global economy's primary creditor for decades. They've been the wealthy relative, the rich uncle everyone in the family depends on when they need capital. Here's how the mechanism worked. For years, Japanese savers and institutions watched their domestic savings earn absolutely nothing, 0% returns sitting in Japanese accounts. So logically, they sent that capital overseas, hunting for any kind of return. They became massive purchasers of United States Treasury securities. They loaded up on European sovereign bonds. They poured hundreds of billions into American technology equities. The scale is almost incomprehensible. Japan currently holds more than $1 trillion of United States government debt instruments alone. They own hundreds of billions more in American corporate equities. This buying activity wasn't just investment strategy, it was the structural foundation supporting global asset prices for an entire generation. But right now, at this very moment, that entire dynamic just flipped upside down. With domestic Japanese yields rocketing up to 4%, the mathematical incentive structure has completely reversed. Why would any rational Japanese institution continue accepting the currency risk inherent in holding dollar-denominated assets? Why would they tolerate the exchange rate volatility, the political uncertainty, the distance and complications of foreign markets, when they can now achieve 4% returns at home denominated in their own currency, without any of those additional risk factors? The simple answer is they wouldn't, and they won't. What we're about to witness is capital repatriation on a scale the modern financial system has never experienced. I'm talking about trillions of dollars of liquidity getting vacuumed out of global markets and rushing back toward Tokyo. Think of it as a giant reverse whirlpool, pulling everything toward the center. This phenomenon already has a name among market professionals. They're calling it the Great Repatriation. And this repatriation event is the triggering mechanism for what amounts to a global margin call of unprecedented proportions. To understand the full implications, you need to think about the entire global financial system as essentially one massive leveraged trade. For years, sophisticated hedge funds, international banks, and institutional investors have borrowed money denominated in Japanese yen because borrowing costs were essentially free, sometimes literally zero, occasionally even negative, where you got paid to borrow. They'd take that free borrowed money, convert it into other currencies, primarily dollars, and deploy it into higher yielding assets. They bought shares of companies making microchips and artificial intelligence systems. They piled into digital currencies and speculative technology ventures. They purchased real estate from Manhattan to Mayfair. This strategy, known throughout financial markets as the carry trade, has been one of the most profitable and persistent trades in modern financial history. But here's the problem with any leverage strategy. When the cost of your borrowed money suddenly skyrockets, when yen borrowing costs go from zero to something significant, the entire trade collapses. And it doesn't collapse slowly or gracefully. It implodes violently. Here's the mechanical reality of what has to happen next. These traders, these funds, these institutions, they all have to repay their yen-denominated loans. To generate the yen needed for repayment, they have no choice but to sell the assets they purchased with that borrowed money. They have to dump their shares in the semiconductor manufacturers. They have to liquidate their cryptocurrency positions. They have to sell their real estate holdings. And they all have to do this simultaneously, in a crowded exit where everyone's trying to get through the same narrow door at the same time. The spike in Japanese bond yields isn't just another data point on a chart. It's the pin that's about to pop what many are calling the everything bubble, the largest speculative bubble in human history, built on decades of artificially suppressed interest rates and unlimited liquidity. Reports circulating among financial industry professionals indicate that Japanese institutions are actively preparing to liquidate approximately $500 billion worth of United States equities. $500 billion. To put that figure in perspective, that's roughly equivalent to the entire market capitalization of Tesla or a major energy giant being sold into the market over a compressed time frame. The biggest single player in this unfolding drama is the Government Pension Investment Fund of Japan, universally known by its acronym GPIF. This is the single largest pension fund on planet Earth. They hold assets measured in the trillions of dollars. And a substantial portion of those holdings consists of United States technology stocks, the mega cap names that dominate global indexes. When you check your retirement account statement and feel satisfied about your gains, there's a high probability you're looking at the exact same stocks that GPIF holds. You're in the same crowded trade, sitting in the same boat. But here's the critical difference that changes everything. You're holding those positions for retirement, planning to sell decades in the future. They're selling for survival, and they're selling right now. As the value of their domestic Japanese government bond portfolio collapses due to rapidly rising yields, they face what's called a solvency hole, a gap between their assets and their liabilities. Pension funds aren't optional investment vehicles. They have hard liabilities, monthly obligations to pay retirees their promised benefits. When their safe assets, the government bonds that were supposed to be rock solid, lose substantial value, they're forced by regulation and fiduciary duty to sell their risk assets, their equity holdings, to raise cash and fill that hole. This isn't a choice or a strategic decision. It's a legal mandate. It's forced selling, the most dangerous kind because it's price insensitive and relentless. The intelligence we've been analyzing provides a very specific timeline structure for how this unfolds. They won't dump all $500 billion at once because that would be too immediately catastrophic. It would trigger obvious market panic and potentially invite intervention. Instead, they will slowly, methodically liquidate these positions over the next 12 to 24 months. This gradual approach is actually far worse than a sudden crash. In a flash crash scenario, prices plummet, panic reaches crescendo, weak hands capitulate, and then bargain hunting buyers step in to stabilize the market. The event is violent but brief. Markets recover relatively quickly. But a slow liquidation, a structured selling program extending over 1 to 2 years, functions as torture for equity markets. It creates what traders call permanent overhead supply. Every single time markets attempt to rally, every time hope emerges and momentum builds, Japanese institutional algorithms will step in and sell into that strength. They'll use the liquidity provided by optimistic buyers to exit their positions. This puts an invisible ceiling over the market. It suppresses gains during rallies and amplifies losses during declines. But there's another layer to this repatriation dynamic that makes it even more dangerous. When a Japanese fund sells a United States stock, they receive United States dollars as proceeds. But they don't need dollars. They need yen to pay pensioners living in Japan. So they take those dollars and sell them in the foreign exchange market to buy yen. This mechanically drives the value of the dollar downward and pushes the value of the yen upward. The weak yen was the essential fuel that powered the global carry trade for over a decade. For years, hedge funds could borrow yen at 0% interest, convert those yen into dollars, and buy equities. It was effectively free money. But as the yen strengthens, driven by these massive repatriation flows, the entire carry trade structure explodes. This creates a feedback loop from hell, a self-reinforcing cycle that accelerates once it begins. Japan sells stocks, driving the yen higher. Higher yen blows up leveraged carry trades. Hedge funds liquidate positions to meet margin calls. Additional stock selling drives markets lower and yen even higher. More carry trades blow up. More stocks get sold. The cycle feeds on itself, amplifying with each iteration. Now we must turn our attention to what I consider the elephant in the room, the asset class that literally holds the entire global financial system together. I'm talking about United States Treasury bonds. Japan currently holds over $1 trillion of United States government bonds. They are the largest foreign creditor to the United States. With Japanese yields soaring to 4% at home, Japanese institutions have no mathematical reason to continue holding United States debt. So they're going to sell. And they're not going to sell just a little bit. They're likely to sell hundreds of billions of dollars worth of Treasury securities to repatriate their capital back to Japan. This creates the Fed's nightmare scenario. The United States is currently carrying over $38 trillion in national debt. We're running an annual deficit of approximately $2 trillion. We need to sell billions of dollars worth of new debt every single day just to keep the federal government operating. For decades, those buyers were foreign central banks. China bought heavily, Russia bought, Saudi Arabia bought, and most importantly, Japan bought consistently and in enormous size. Now look at that roster of buyers today. Russia has sold virtually everything. China is actively selling their treasury holdings to accumulate gold and hard assets. Saudi Arabia is diversifying reserves. Japan was the last major buyer still standing. If Japan steps away from the auction, who's left to buy? The answer is nobody. When you have more sellers of bonds than buyers, bond prices crash. And when bond prices crash, yields mechanically rise. If Japan dumps their treasury holdings aggressively, we could see yields spike to 6 or 7% overnight in a disorderly market. If the 10-year Treasury yield hits 6%, the United States economy stops functioning. Mortgage rates would surge to 10% or higher. The housing market would freeze. Auto loans would hit 12%. Car sales would collapse. Corporate debt would become unserviceable. We'd see massive waves of corporate bankruptcies. At current interest rates, the annual interest cost on the national debt already exceeds $1 trillion per year. If interest rates double, those interest payments would jump to $2 trillion annually. So what's the solution? The Federal Reserve knows that if Japan sells aggressively, they have to buy. They cannot allow yields to spike uncontrollably. So they will restart the printing press. They'll announce a new program with some carefully crafted name. They won't call it quantitative easing because that term is now associated with inflation. They'll call it market stabilization or liquidity support, but the mechanics are identical. The Federal Reserve will create trillions of new dollars electronically out of thin air. They will use those newly created dollars to purchase the treasury bonds that Japan is selling. This process is called debt monetization. When you monetize debt on a large scale, you solve the immediate liquidity crisis, but you create a currency crisis. You save the bond market in the short term, but you destroy the currency in the long term. This is why silver is hitting $94 per ounce right now, and gold pushed beyond $4,600. The smart money understands that the Fed is cornered with no good options. They know the Fed has to choose between depression, allowing interest rates to rise and the economy to collapse, or high inflation, printing unlimited money to buy bonds. And they know that in a debt-based system, the central bank always chooses inflation. They always choose to print. When the Federal Reserve prints $3 trillion to purchase Japan's bonds, where does that money go? It dilutes every dollar in your savings account. It destroys the purchasing power of every dollar you're holding as cash. Investors are buying silver because they're fleeing the dollar. They're preemptively positioning for the monetization event they know is coming.